Hello guys, welcome back to my video. So indeed, don't mind that, it's just the torture of a few victims, don't mind that, absolutely normal, don't worry. Okay, so in this video we'll be talking about bonds. Okay, so bonds are basically large sums of money given. Okay, you guys get what the point of bonds is, that's not why you want to, or that's not why you watch the video. Okay, so in this case in macroeconomics, bonds are given by the government. Bonds are given by the government. There are a few terms you should be familiar with. There's the bond price, there's the coupon rate, and then there's the discount factor. Let's say it's R interest rate. I'm just saying the R is the discount factor. So discount factor is basically the amount of the percentage value per year that the money depreciates, because money doesn't stay constant throughout the years. $1,000 now is worth less in 10 years time, because I'll give you an example. If you guys are retarded, if you guys are mentally ill and don't know what the discount factor is, I mean, for those who this video was intended for, the discount factor, let's give you an example again. So let's say you have $1,000. You can either have this $1,000 now, and let's say the interest rate is 10%, or you can have this $1,000 in 1 year's time. $1,000. So when I first learned this, I told myself, I'll have it in 1 year's time. I'm chill. I don't use it now all in one moment. I'll wait 1 year. I'll think of what I'm going to buy with this 1,000, and then I'll use it. So then after sir taught us what this was and told us we are all retarded. So the $1,000 one is a better way to go. Why do you ask? 10% is the discount factor, right? $1,000, 10% is the interest rate. $1,000 now would mean in 1 year's time, with this $1,000 you would have 1,000 into 1.1. That's 1,000 into 10%. That's in 1 year's time you'd have 1,100. Right? I hope I'm recording this video. It'd be so annoying if I didn't okay, it's recording. Is it all being shown in the camera? Yes. So it's better to have 1,000 now than 1,000 in 1 year's time, because you can make more money in 1 year's time if you have 1,000 now actually. So anyway, let's think of that 1,000 if you had 1 year's time. Okay. Let's say 10% is the discount factor, because I told you money isn't constant, money depreciates over time. 1,000 into 10%, that means that's the future value, right? 1,000 into 10,000, 1,000, you get 1,000 in the future. That's the 1,000 is the future value. To get that value to what it will be worth now at this current moment, if you took 1,000 in the future, we need to calculate something called the present value. Okay. So which is present value is calculated by future value divided by 1 plus r by over n. N is the number of years into the future. It is, in this case, it's 1 year into the future. So we put 1, and the future value is 1,000. And since I'm horrible in maths, I will be using a calculator. Give me a moment. My trusted calculator, which will not be allowed in the exam. So 1,000 divided by 1 plus r. 1 plus r is basically 1 plus 0.1, 1.1, and that value gives you 909.09. So if you would take 1,000 to the future, basically that would be 909 today. So what the options I gave you before was either 1,000 now or 909 in the future, if you take into account the discount factor. Just remember, money doesn't stay constant, money depreciates. That's why discount factor exists. Interest rates, you could either have okay. I'm going into when I think too much, my voice doesn't match up with my mind, so it just go. Okay, you got what discount factor is. Coupon rates. So an example I'm going to give you is a bond of, say, okay, Sri Lankan bonds are valued at $10,000 each, which is no wonder why we just give foreigners our bonds and no one locally buys it, because no one has $10,000 laying around anymore. Besides that that guy who can register in Sri Lanka. Let's say it's $10,000. The bond price is $10,000. The bond face value is $10,000. I will get to that later. Coupon rate is basically the rate of interest you get. Coupon rate is basically the rate of interest you get per year from this 10,000, the face value. I'm not going to say FV because you'll get confused with face value and future value. So let's give an example. Coupon rate is 8%. Okay, and let's say this bond matures in about 5. No, that's too long. 3 years. Okay, 10,000. Every year you're getting 8%. 8% is 800. The way bonds work is not the same as the bank loan works. Okay. Bank loans, you principal payments. That's the payments that's the payment of the original amount, and the interest payments. That's the payment, the excess payment, which the interest payment. So the way bonds work is you get a coupon payment every year. That's the interest payment to yourself from the government. You get a coupon payment every year. On the last year, on the year 3, that's when you get the $10,000. So basically it's year 1, year 2, year 3. So first year you get 800. That's the coupon payment. Second year again 800. Third year 800 plus the initial principal payment. So that's total of sorry, I told you it doesn't work. 10,800, right? Remember this, discount factors exist. Okay, money doesn't stay constant. So for each of these years, you have to calculate the discount factor. An example, in this instance, I'm going to give you an example of 10%. Okay, discount factor is 10%. Okay. Yeah. So for every year, the value of money depreciates by this 10%. Okay. So in year 1, remember I told you future value divided by 1 plus R over the number of years equals the present value. Now this is another part you've been waiting for, the first thing, the bond price. How is bond prices calculated? It's not something taken from a Harry Potter book. I mean, probably it is, but in real life, it's not that easy. Bond prices are calculated with the present values of all the future cash flows. Year 0 is when you pay the price of the bond. How is this bond price calculated? Bonds are given face values. In this case, the bond is $10,000. That's the face value of the bond. I'll get to that in a second. Face value is 10,000 in this case. The price of a Sri Lankan treasury bond. Treasury bond. So to get the present value of each of these year 1, 2, 3, you divide it by, this is the future value, right? To get the present value, divide it by 1 plus R. And in this case, 1 plus R is 10%, so 1 plus 0.1. Since it's year 1, it's basically the same as saying 1 plus 0.1. And for year 2, it's 1 plus 0.1 squared. Okay, I'm assuming you know this, but if you don't, I'll make another video. For year 3, it's 1 plus 0.1 cubed, year 3. Okay, because year 3 is 3 times of 10, that's 30%, but 1 plus 1, 1.1, no wait, don't think that. Anyway, so when you get the present value of each of this, you add them up, and that's your price. In this case, it's gonna be very awkward because I'm not going to edit this video, so you're going to see real life how slow I am in making these. Squared plus a 10,800 fraction thingy, 1.1 cubed. Okay, so the present value is 9,502. It's rounded off. So this is the actual price you pay for the bond. Now you may think to yourself, I'm buying a bond in the hopes I make a profit in the future. But in reality, you pay 9,502 to get the future value of 9,502. Remember this. That's in this case. That's if you hold the bond till maturity, 3 years. You can also sell the bond. This is just a very basic thing. This is like boggled down to the basic level, but there are different interest rates change as well. I'm assuming it's a constant 10% interest for the 3-year maturity. I'm assuming it's just constant 10% interest discount factor. It could be different. So yeah, that's about it. Don't forget to like, subscribe, comment below. Next week's Fortnite results are out soon. Hopefully it's recorded. Oh, it's perfect. Hopefully it's perfect. Oh, it's 12 minutes.